Welcome to the deep dive. Today we're looking at Palantir. I mean, the stock's performance has been pretty wild, and there's this big question floating around. Can it actually hit a $1 trillion market cap by 2030?
It's definitely a huge target. And yeah, we've got an article here from the Motley Fool. It just came out May 9th, 2025, that kind of digs into whether that's even plausible.
Exactly. So our mission today is to unpack, what's really behind Palantir's growth, what hurdles they might face, and based on this analysis, just how realistic is that $1 trillion number?
That's good. Where should we start? Recent performance.
Yeah, let's jump in there, because they have been on quite a tear, haven't they?
Oh, absolutely. The article highlights this staggering 1,000% stock increase over just the last 3 years. I mean, that's massive.
Wow. 1,000%. And didn't their latest earnings report, Q1 2025, add fuel to that fire, initially at least?
It certainly looked that way. The numbers were really quite strong. Revenue growth actually picked up speed, hitting 39%.
39%, okay.
Yeah, reaching $883.9 million. That was, comfortably above the consensus, which was around $862 million.
And profitability looked good, too.
Definitely. Their GAAP operating income more than doubled, hit $176 million. That translates to a pretty healthy 20% operating margin.
Okay.
And adjusted earnings per share, that came in right where analysts expected, so $1.13, which, is up nicely from 38 cents last year.
So strong numbers across the board. And they seem pretty bullish about the full year, too.
They did. They actually raised their full-year revenue growth guidance to 36%.
Okay.
Putting the range between $3.89 billion and $3.902 billion. And again, that's higher than the street was expecting, which was more like $3.75 billion.
Yeah.
So, fundamentally, things look good.
And this is the interesting part. Despite all that good news, the stock, it dropped afterwards, right?
Yeah, that's the twist. It fell about 12% on the Tuesday after the report.
So what gives? Great results, but the stock sells off.
Well, the article points straight at valuation concerns. It seems that's the main driver. Even after that drop, the price-to-sales ratio was still sitting at, 82.4. That's pretty high.
82 times sales. Okay. Yeah, that's steep. So the market is basically saying, great quarter, guys, but you're already priced for perfection, and then some.
Kind of feels that way. It suggests maybe the price already baked in, not just this good news, but maybe a lot more future good news, too.
And this connects to that 1,000% run-up over 3 years. It wasn't all just the business growing, was it?
No, that's a really crucial point from the analysis. It references Y-charts data suggesting something like 2/3 of that huge gain wasn't from revenue growth itself.
2/3. So what was it then?
It was what they call multiple expansion. Basically, the market deciding to pay a much higher price for each dollar of Palantir sales compared to before. A re-rating, you could say.
Okay, so investors just got way more optimistic about their future prospects.
Exactly. Now, the article is fair. It does say this re-rating wasn't totally out of the blue. Palantir has shown better growth and, importantly, a clear path to profitability. So, some re-rating was probably deserved.
But maybe not that much. Or at least that current high multiple implies a lot has to keep going right.
Precisely. A price to sales of over 80 assumes growth stays very, very high for quite a while.
And well, that's always the big question, isn't it? Can they keep it up?
So how does this valuation look when you put Palantir next to other big software players? Are they way out of line?
Well, they're definitely in the big leagues now. Market cap over $250 billion, one of the most valuable sort of pure play software companies out there.
Okay.
But yeah, when you compare that price to sales ratio, the 82, to peers like Salesforce or ServiceNow or Intuit, it stands out.
How much higher is it?
The data mentioned shows Palantir's multiple is more than 5 times higher than those guys.
5 times? Wow. And how does their growth compare? Is it 5 times faster?
Well, no, that's the thing. Their revenue growth is faster, but maybe only about twice as fast, roughly speaking. So you're paying a much, much higher premium for each point of growth compared to those established companies.
Exactly. And there's also the scale difference, which is pretty stark.
Right. The article mentioned that Palantir's trailing revenue is just over $3 billion.
Yeah, whereas those peers, they're doing well over $10 billion. Salesforce is way up there at $38 billion.
So Palantir is much smaller, growing faster, but not that much faster, yet valued way more richly on a sales basis.
Correct, which tells you the market is baking in some really significant future growth expectations.
What kind of expectations? Does the article quantify that?
It suggests the current price implies investors see Palantir hitting at least $10 billion in revenue fairly soon.
10 billion. Okay, so going from about $3 billion now, what kind of growth rate does that require?
To get there, they'd need to keep growing at around 40% per year for another 3 years or so, beyond 2025.
40% annually for 3 more years. That's a strong pace to maintain.
It really is.
Yeah.
Especially given, potential economic headwinds or just the law of large numbers kicking in eventually.
So let's say they do manage that. They hit $10 billion revenue by, say, 2028. What happens to that price-to-sales multiple if the stock price just stays flat?
Interesting thought. Well, the calculation in the article suggests the PS ratio would drop down to about 25.
25. Okay, so still not cheap, but maybe.
Pricey but reasonable is how the article puts it, yeah, for a company showing that kind of sustained growth.
But that's assuming the stock price doesn't move for 3 years while the revenue triples, which seems unlikely.
Unlikely, yes.
Yeah.
It's more of a thought experiment to show how much growth is needed just to sort of grow into the current valuation.
Got it. Which brings us right back to the main event. Can Palantir actually hit a $1 trillion market cap by 2030?
Yeah, the trillion-dollar question. And the article says the absolute key here is their total addressable market, or TAM.
How big is the market they're playing in?
Well, that's tricky. Palantir doesn't actually give out their own TAM estimate. And, analysts' estimates are kind of all over the place.
But the core idea is, for them to get that big, their potential market needs to be huge and probably growing fast itself.
Exactly. And the driving force behind that potential TAM growth, according to the analysis, is really the widespread adoption of AI. That's the big catalyst.
Okay, so let's run the numbers. To be worth $1 trillion by 2030, what kind of revenue would they need? Let's assume, maybe, that PS ratio settles at that pricey but reasonable 25 we just talked about.
Right. So if you use a 25 times sales multiple, a $1 trillion market cap means they need to be generating $40 billion in annual revenue.
40 billion. Okay, wow. They're forecasting maybe close to $4 billion for the end of 2025.
Exactly. So going from roughly $4 billion into 2025 to $40 billion by 2030. That requires something like 60% average annual revenue growth over those 5 years.
60%. Their current guidance is 36%. That's a significant acceleration they'd need.
A very significant acceleration, yeah. That's a very, very high bar.
What about profits? If they somehow hit $40 billion in revenue, would the valuation make more sense on an earnings basis?
The article explores that too. It throws out a hypothetical. If they achieved, say, a 30% GAAP profit margin on that $40 billion.
Okay, 30% margin.
That would mean $12 billion in net income.
Right.
So a $1 trillion market cap on $12 billion of earnings gives you a price to earnings, or PE ratio, of about 83.
83 PE. Still high, but maybe justifiable for that kind of massive growth story.
That's the argument, yeah.
Yeah.
The article calls it potentially reasonable in that specific context, assuming they actually achieve that 60% growth and the 30% margin. Lots of assumptions there.
Big assumptions. Now, the article does acknowledge Palantir is making progress, right? Landing new customers, new products.
Oh, absolutely. It mentions their success in customer acquisition and highlights, for instance, NATO adopting their Maven smart system. That's a significant win.
Yeah, shows traction in key areas, both government and increasingly commercial, too.
For sure. The platform is clearly powerful in finding its footing.
But getting to $40 billion revenue by 2030...
It's still described as a tall task, especially, with economic uncertainty always lurking.
So the overall message seems to be hitting $1 trillion eventually. Maybe. Especially if AI adoption really explodes. But by 2030... that looks incredibly ambitious, given the current numbers.
Yeah, I think that's a fair summary of the analysis. It suggests maybe tempering near-term expectations for the stock's growth.
Because the valuation is already pricing in so much success.
Exactly. The execution has been, as the article says, phenomenal, but the valuation seems to leave little upside potential right now. That post-earnings stock drop is kind of exhibit A for that argument.
Okay, so let's quickly recap this deep dive then. We look at the Motley Fool's analysis of Palantir. Clearly, they're showing impressive growth, moving towards solid profitability, tapping into this huge interest in data and AI.
Right, but that growth is paired with a very, very high valuation.
Which makes the path to $1 trillion by 2030 look extremely steep. It really hinges on their addressable market expanding dramatically, mostly fueled by AI, and them capturing a huge chunk of it at an accelerating pace.
A pace significantly faster than even their current strong growth.
Okay, so that brings us to our final thought for you, the listener. Thinking about everything we've discussed, the high valuation, the massive growth needed, the reliance on AI adoption,
What specific signs or metrics will you be tracking over the next few years to judge if Palantir is actually on a path towards that trillion-dollar goal? And maybe what unexpected things, positive or negative, could pop up and really change that whole trajectory? Something to think about.